pretty flat, and that's actually a flat start to the trading week as well. You're looking at the broader markets showing more by way of traction in the session thus far. But let's straight dive into the macro discussion for this afternoon, which is really about the GDP numbers, which are slated to come in for quarter three later today. Maithili Visnarmath, our consulting editor at ET Now, joins in with her perspective. We also have Devendra Pant of India Ratings, Chief Economist and Head Public Finance, joining us with his perspective. Good afternoon to both of you. Maithili, start off with you. I mean, while the expectation is running at a level of 7.1, it's really the outlook and how this data adds up to the performance in FY16 and what that means for growth in the next year, in financial year FY17.
Absolutely, Tanvi. Apart from the Q3 numbers that we'll get today, we'll also get the revised numbers for each of the previous 2 quarters. And we'll also get more significantly the advanced estimates for this year. And that, I think, is key to what the government will decide also in its budget. Because if you look at the previous 2 years, we've seen the nominal growth of GDP come down in each successive year, 2013-14, 14-15. And this year, because of the negative GDP deflator, we're going to see a nominal growth which is even less. So the nominal GDP number, the advanced estimate, will be significantly lower than what I think the previous budget had estimated at 11.5%. So that will give you a much lower denominator and will make the government's task of achieving that fiscal deficit ratio target much more difficult. In absolute numbers, I do expect that they will manage that. But as far as the ratio is concerned, I think it will be a little difficult. As far as the third quarter GDP numbers are concerned, I think even though you will get a lower number than what we saw in the second quarter of 7.4%, I think the advantage that you're going to get in the third quarter is that the previous year's third quarter was significantly lower than the second quarter. As against 8.4 in the second quarter of last fiscal, you got only 6.6. So that should give you a statistical boost for the third quarter. Having said that, since the Reserve Bank of India in its recent monetary policy statement had said that it saw signs of slower activity in the third quarter, I do agree with your poll estimates that it will be in the low 7s, 7.1, 7.2, because the first half year we've only seen 7.2. So I think if we get another 7.1, 7.2, we'll not be very far off from the overall estimate for the year as a whole, because the fourth quarter should do substantially better. The third quarter was little depressed, particularly because of agriculture. Services, of course, we've got a boost. But there again, the third quarter services, last fiscal, the third quarter, we got a huge boost in services of close to 20% in public administration of all things. So this year, I think we're not going to see that number. So overall, 7, 7.1, 7.2, that is my best guess. But I don't know whether Devendra agrees, because India Ratings actually has been a little bit more upbeat on the third quarter. So let me bring in Devendra at this point. Devendra, what explains your slightly more optimistic view of the third quarter as against the Reserve Bank of India? I wouldn't say it's pessimistic, but certainly less optimistic than your estimate.
Well, Maithili, if we look at the economic activity, naturally the economic activity has not been very strong. So when we look at from the GVA side, we are looking at a number which is 7.1. But when we look from the GDP side, that is the expenditure side, one has to bring in and factor in the kind of whether we look at your capital consumer durable production, or whether we look at what has happened when all these e-tailers, Snapdeals and Amazons and Flipkarts, the kind of sale they have been able to achieve. So that is pushing our GDP growth number higher than with most of the other market participants. And look, on annual basis, one can expect the identity holding true. But on the quarterly basis, the old identity of GDP MP and GDP factor cost, which still exists, GVA plus taxes minus subsidies. Look at the kind of indirect taxes collection growth we are witnessing. The subsidies are going down and less than what they were in the previous year, mainly because of oil. So we expect the boost on GDP side, because of the one factor which you have also mentioned in your statements, like the third quarter last fiscal was 6.6%. And mind you, when we are working on these numbers, we are looking at these quarterly numbers. These are in relation to what was 7.3 annual growth, which has gone down to 7.2. So there will be some kind of kick coming in from those numbers. Now, if we don't do 7.5, 7.6 this year, then maintaining our focus for the entire fiscal is 7.4. So if we don't clock a growth rate of 7.6 or so, it will be very difficult even to achieve 7.4% growth in the entire fiscal.
Okay. Yes, of course, it will be difficult to achieve that growth number for the year, but we'll have to take whatever the numbers give us. So we're joined over here by Shanti Ekambram of Kotak Mahindra. Shanti, can I throw that same question across to you? What is your best guess for the Q3? And do you expect growth to look up as compared to the previous quarter, or do you expect it to trend down slightly? And also, what is your best guess for the advance estimate numbers? Because we're going to get advance estimate numbers also for this fiscal, and that's going to play a very crucial role in what the government estimates in terms of the budget, the numbers, fiscal deficit, revenue targets. It has a bearing for a whole host of things in the budget exercise. Shanti?
If you look at, we've already started, Jan is over. Jan was a little more muted than what one would expect it to be. And I think what will happen in Feb and March, you will see government spending, which typically is spent up and happens in the last 2 months. I'm hoping that will happen, will really come in to give that boost that we need. So from my perspective, I'm hoping that we will reach the trajectory of about 7.5, because there would be a boost to spending that will happen in Feb and March. Most of the departments have to meet their targets. If you looked at Q3, you saw that the consumer segment and the consumption was quite robust. January was a little muted, but again, the month of March, you'd see a spike again in the consumption. So my estimate is we've got to go on the assumption that there will be spending and there will be a boost, and maybe we should be around the 7.4, 7.5 mark. Having said that, the whole private investment cycle is still going nowhere, and that's really not sort of happened. So we've got to see now what comes out in the budgets, and then the government will have to then step in and really fill the gap.
Absolutely. I think the government has been stepping in and filling up that gap for the past many quarters now, because the private sector just has not responded. But Devendra, if I can come back to your discussion of GDP and GVA and why you feel the third quarter GDP will be higher than GVA, there's entire debate about which is the correct number to look at when you're looking at the economy's health. Is it GVA? Is it GDP? And how significantly does it matter whether you look at GVA or whether you look at GDP? But I think the CSO would like you to look at GVA rather than GDP. But what would you like to look at? What would you like to tell our viewers? Which do you think is a more important metric for the economy?
Well, if we look at in aggregate, I think GDP is no doubt is a better measure of economic activity. Reason being, like the GDP will give you just the value of the production, but on the when we look at the GDP, it takes into account what households are paying taxes and the kind of subsidies, whether it's the household or the corporates or the business houses are receiving. One major reason of disconnect right now, what you often keep on hearing, is the kind of whether it's the 7.5 or 7.2 or whatever, any growth upward of 7% is not visible on ground, and it is mainly the reason for that is what has happened to the prices. If we look at the sectoral level, there are many sectors where we are witnessing strong volume growth. Say, for example, if you look at petroleum product consumption, April-November growth is 9.1% in quantity terms, and this is what feeds into the GDP calculation. But when we start looking at oil sector, we start looking at from the company balance sheet or the corporate balance sheet. There, what is happening that the 20% degrowth in the prices is leading us to a level which is 12% degrowth in the company top lines. So GDP is no doubt is a superior measure. Unfortunately, what has happened is two things. A, we were so used to of looking at GVA, and because simply we were looking at GVA, whenever you look the cross-country comparison, we have to move away. Okay, India's numbers are GDP, rest are the GDP at market prices, and this is what the UN system of national accounts has suggested, which is being followed one after the other by all countries, those who are member of United Nations. The second point which has happened is we haven't thought in our wildest dream that in India we will see a deflation in the producers' prices, and that too for a prolonged period of 14 months. We expect even in the January also we have a deflation, though slightly lower. So that is basically distorting entire picture. Whether you say the budget arithmetic, or whether you say the company corporate performance, or even the government's performance. Thankfully, because of low oil prices, we are getting a lot of excise duty on oil. Otherwise, our tax collection would have suffered, because the economy in the nominal term is not growing at 11.5% as assumed in the budget estimate. Our estimate suggests it will be somewhere around 9.5% or so. So that is creating problem. But no doubt the GDP, because it takes into account whether the household or corporates are paying and what they are getting, and that is measuring the aggregate demand. When we talk about the aggregate demand is measured in the form of GDP at market prices.
Shanti, Devendra has spoken like a true economist, but would you agree with that assessment that GDP is a more relevant number? Because actually GVA is what gives you the value added. So if we're talking about sheer economic activity and not taking into consideration the indirect taxes and subsidies, which are after all artificial constructs to the value addition in the economy, would you veer in favor of using GVA rather than GDP? Or would you go along with Devendra in saying that GDP is a better measure?
We normally look at GDP as a better measure, and we've been looking and calculating GDP. Whether it's on the ground, whether it's banks, even whether it's economists, GDP has been the measure that we've been looking at as a measure of growth. So we'll have to look how you go forward, but GDP would perhaps be the better indicator to look at.
Okay, and if the GDP doesn't give you a very healthy number, even though the GVA might give you a fairly healthy number in terms of economic activity, Shanti, do you think the government should go by the GDP number in calculating its, assessing whether the economy is recovering? After all, policy imperatives follow from these numbers. If the numbers are below what you think is the potential growth of the economy, then maybe there is a case for some kind of a fiscal stimulus. But if the numbers indicate that the economy is growing very close to potential, then maybe the government should hold back for fear of overheating. So given these two kind of alternate approaches to the entire numbers, is there really a case for a fiscal stimulus in whatever sense, in terms of government taking a slightly more relaxed view of the fiscal deficit? Would you argue that the economy is operating below potential, or would you say it's very close to potential? Shanti?
See, you have to be consistent with whatever base you use. You cannot keep switching bases. If you look at it for the past few years, we've used GDP as a number. As we look at the entire balance sheet, growth, fiscal dynamics, etc. of the economy. So I would say that for now we should continue with the consistency of the metric that we have used. Now, if you translate that into what is happening on the ground, the real issue is that you have not seen investment cycle kick in. It is still the consumption cycle that is leading to the growth as far as India is concerned. Now, if you look at the capacities that are getting added, they're still very small in the manufacturing sector, and we do have unutilized capacities. So unless you see, demand, supply, sort of dynamics changing and investment going, you will still be looking at how do you get to the kind of growth numbers you want. So my sense is that with the thrust on infrastructure, roads, and some of the good work that the government has been talking about, and the fact that government has a large kitty thanks to the oil prices, which have not been really passed on entirely to the consumer, they should use to really looking at where should they invest the money and outlay the funds so as to give a kick to the economy. So in my sense, coming back to fiscal consolidation, 3.5 is a number that they had originally said slated for next year. That goes up by 10-20 basis points. It is not the end of the earth. But if that is utilized towards productive investment, I think it will go a long way in ensuring a much healthier economy.
All right, Shanti, Devendra as well as Maitli, thanks very much for rounding up that discussion. All eyes will be on the Q3 GDP numbers that come out later today. Let's see where the number settles for for the quarter. Let's, before taking that break, get a quick perspective on the technicals.